The longer it looks like the war is going to continue, the more people are selling gold. At some point, gold is going to start to go up when the escalation goes up. Silver right now is about 71.5, so about $8 higher than it was Monday morning. So better than, again, 10% bounce off of those lows. But I think that it's nuts that we're at war and the fundamentals for gold and silver are better than they've ever been. They were great before the war. They're even better now that we have a war. If inflation goes from 3% to 6%, that's better for gold than inflation staying where it is and the Fed cutting. Gold's back above 4,500. So it's already bounced more than 10% from Monday morning's low. But that 40% retracement is exactly the decline that we got the bull market in gold from 2001 to 2008. If gold does the same thing again, has a 40% retracement and then triples, gold's over 11,000. Now, I actually think gold's going to go a lot higher than that. I think gold's down. In fact, by Monday morning, early Monday morning, like 3, 4 in the morning, I forget, gold almost hit 4,100. It got down to like 4,120. I mean, it was at 5,500. It was when the war broke out three weeks ago or 4 weeks ago, whatever it was, gold hit 5,500. And then Monday of this week, 2 days ago, it almost hit 4,100 even. On this news, on this, escalation. Dollar was up. So the markets are really, moving on the escalation. Now, of course, this is ridiculous when it comes to gold. It shows you how liquidity driven everything happens to be right now in this massive bubble that the Fed has inflated. Gold goes down when the war gets escalated, but it goes up when it gets de-escalated, which is the opposite of what you would think. You would think that when the war looks like it's going to be bigger and last longer and be more disruptive, you should want to buy gold. But if it looks like the war is over, you'd want to sell it. But the opposite is happening. The longer it looks like the war is going to continue, the more people are selling gold. I mean, if they declared peace tomorrow, the whole war is over.
The market isn't reacting to war risk. It's reacting to liquidity signals hiding behind it. As Peter Schiff points out here, gold falling from 5,500 to near 4,100 during escalation exposes how dollar strength and rate expectations are overpowering traditional safe haven logic. This is a classic liquidity distortion, where investors chase short-term positioning over macro reality. When the dollar spikes, gold gets mechanically sold, even if risk is rising. That tells you institutions are trading policy timing, not fundamentals. Next, Peter Schiff discusses why this disconnect gets even worse when inflation expectations shift beneath the surface.
Gold was soar. That doesn't even seem to make any sense. And, part of it, too, is linked to the idea that the longer the war continues, the longer we're going to have to wait for the Fed to cut rates. And that elongated wait for the rate cut, that's what's weighing on gold, which is irrelevant. Because the entire time the Fed is going to be on hold, inflation is going to be getting worse. And so real interest rates are going to keep going down, even if the Fed holds nominal interest rates the same. And, if inflation goes from 3% to 6%, that's better for gold than inflation staying where it is and the Fed cutting. Because what's important for gold is real interest rates. The nominal interest rates at the end of the day don't matter. Even if the Fed raises interest rates to 10%, if inflation is 30%, do 10% inflation interest rates matter? No, you're negative 20%. You would want to buy gold even more aggressively if we had 10% interest rates and 30% inflation. So it's the real rate that is important. And the traders still don't get this. Now, eventually, if the war goes on long enough, this is going to stop. At some point, gold is going to start to go up when the escalation goes up. But we haven't reached that point yet.
Markets are obsessing over the Fed timeline while completely ignoring what actually drives gold long-term. As Peter Schiff points out here, if inflation jumps from 3% to 6% while rates stay flat, Real yields collapse, yet traders are still pricing gold off delayed rate cuts instead of deteriorating purchasing power. This is a fundamental mispricing. Even historically, gold tracks real rates, not nominal ones. And we've seen this play out repeatedly since 2020. Investors focusing only on Fed cuts are missing the bigger erosion happening underneath. Next, Peter Schiff unravels how this misunderstanding eventually flips gold's reaction to macro shocks.
But I think the pullback, if you look at the pullback to 4,100, that's about 40% retracement of the entire rally. If you measure the rally from the breakout at 2,000, right? That was really where we broke out. So it went from 2,000 to 5,600. A 40% retracement is about 4,100. Now, as we're talking now, and I'm going to get to why this happened, but gold's back above 4,500. So it's already bounced more than 10% from Monday morning's low. But that 40% retracement is exactly the decline that we got. The bull market in gold from 2001 to 2008, or that bull market where gold went from under 300 to 1,000, the 40% retracement there was about what we did in between August of 08 and like November of 08. During those 4 months, gold pulled back about 35%, which was a little bit bigger than the pullback that we've had so far, although this pullback was quicker. Gold's decline since we started the Iran war, it was a much faster decline than the one that was triggered by the 2008 financial crisis. That's how sharp the decline was.
This isn't just a drop. It's a historically patterned reset hiding inside panic ceiling. As Peter Schiff points out here, a 40% retracement from 5,600 to around 4,100 mirrors prior bull market corrections, especially during 2008 when gold pulled back roughly 35% before resuming higher. The key difference now is speed. This decline happened in weeks, not months, signaling algorithmic and leverage flows dominating price action. Fast crashes often mean forced liquidation, not fundamental weakness. The distinction matters for long-term positioning. Next, Peter Schiff shows why these violent resets often precede the strongest phase of a bull market.
In fact, last week was the worst week gold's had since 1983. So way before the 08 financial crisis. But if you look at the magnitude of the decline relative to the entire bull market, what we've already had in 3 weeks is about the same as what we had in 4 months of the financial crisis. But what's significant is after gold bottomed in November of 2008. Now, the stock market didn't bottom until like January, February, or March, I forget, of 09. The stock market fell another 22, 23% after gold bottomed. But after gold bottomed, within 3 years, it tripled. Gold went to 1,900. So if gold does the same thing again, has a 40% retracement, and then triples, gold's over 11,000. Now, I actually think gold's going to go a lot higher than that. I think the fundamentals are a lot better now than they were in 2011. So if gold could triple after a 40% retracement back then, it can certainly do at least that, if not more now, which is why everybody should take advantage of this decline.
The uncomfortable truth is gold often bottoms before broader markets fully break. As Peter Schiff points out here, in 2008, gold bottomed months before equities fell another 20% plus, signaling a shift in capital flows before the panic was visible everywhere else. If that pattern holds, today's decline may not signal weakness, but early positioning. A potential move from 4,100 to over 11,000 sounds extreme, but so did the 2008 to 2011 rally at the time. Investors should focus less on headlines and more on sequence. Next, Peter Schiff discusses why today's fundamentals may actually justify an even larger move.
And by silver, in fact, silver went all the way down below 63. Remember, silver got to 121 or something like that. So almost about a 50% decline in silver from its peak. Not a retracement of the rally, but a complete 50% decline. Silver right now is about 71 and a half. So about $8 higher than it was Monday morning. So better than, again, 10% bounce off of those lows. But I think that it's nuts that we're at war and the fundamentals for gold and silver are better than they've ever been. They were great before the war. They're even better now that we have a war. And I don't care if the war is over. The war is damaging the U.S. economy. Yes, the longer it goes on, the more the damage is going to be. But there's going to be damage even after the war ends. When the war is over, it's not going to be a great thing that we're going to have. I think that Trump is going to promote it as this massive victory, no matter how badly we lose. And not that we lose in a military sense, that Iran defeats us.
Silver collapsing nearly 50% during a war is the kind of contradiction markets rarely explain. As Peter Schiff points out here, a drop from 121 to below 63, while fundamentals improve, suggests forced selling and liquidity stress, not weakening demand. Silver's sharper moves compared to gold often signal where leverage is being unwound fastest. Meanwhile, the economic damage from prolonged conflict doesn't disappear when headlines shift. It compounds quietly through inflation and deficits. Investors ignoring that are focusing on narratives, not outcomes. Next, Peter Schiff unravels how geopolitical outcomes may matter less than economic consequences for markets.
That's not going to happen. But we can lose in an economic sense. We can lose in a sense that we don't really accomplish anything. In fact, I think Iran knows, the Iranian leaders know, that they win the war just by surviving. If the regime is intact at the end of this, then they've won. Because they've stood up to the big American Satan, right? If they're still in power, even if it's different people, if it's the same basic regime, just different players, and who knows what they're going to demand. In fact, if you look, I'm jumping ahead of myself, so I don't even want to get to that. But I think they know, and I think the Iranians know, that at the end of the day, the best weapon they have is the dollar, the stock market, the bond market, the oil price, the economy, the polls. That's going to determine when this war ends. I think that's what Trump is going to ultimately base his decision on, not based on what's going on in Iran or any so-called threat.
Wars don't end on battlefields anymore. They end when markets start breaking. As Peter Schiff points out here, the real pressure isn't military but financial, where the dollar, bond yields, and equity declines dictate political decisions more than strategic wins. This reframes the conflict entirely. If markets weaken enough, policy pivots follow regardless of battlefield outcomes. Investors should watch credit spreads and oil volatility more than headlines, because that's where real stress shows up first. The uncomfortable truth is economic fragility is now a geopolitical weapon. Next, Peter Schiff discusses how political survival becomes the ultimate market driver.
It's going to be the threat to him politically and the Republican Party that's going to be guiding ultimately the outcome here. And I think the Iranians probably know that. And, and they probably think that eventually, look, how many bombs could we have? How many missiles? I mean, we're going to run out eventually, right? Because Trump's already admitted that we've run out of things to bomb. So how many more of these bombs are we going to drop if everything is already destroyed? But in any event, and apparently, obviously, not everything is destroyed because they still have stuff. And they can make more stuff, right? So they can make what we've destroyed. But anyway, so let me get back to this whole scenario here. So Trump set off this big move in the markets based on this ultimatum. Then, out of the blue, on Monday morning, before U.S. stock markets open, he posts on Truth Social, "Hey, great news. We're making a lot of progress in our talks."
Political risk is now trading like a sector, and markets are front-running it aggressively. As Peter Schiff points out here, when policy decisions hinge on polling pressure and election cycles, market reactions become faster and more exaggerated. A single shift in tone can trigger massive repositioning across futures before fundamentals even change. This raises a critical question for investors. Are you reacting to policy or to political theater driving short-term flows? The speed of these reversals suggests institutions are trading headlines, not outcomes. Next, Peter Schiff unravels how sudden narrative shifts can trigger massive, coordinated market moves.
I think we're going to have a 5-day pause on this bombing of the power plants. We're having really productive negotiations. I think we got a deal here. This is great news. I forget exactly what it was, but it was a complete opposite of the tweet on Saturday morning. And of course, it contradicted everything Trump had been saying in the prior week about we're not going to negotiate. There's nobody to negotiate with. Iran wants to negotiate. Iran wants to make a deal. I don't want to make a deal. Screw them. Unconditional surrender. We're going to bomb you into oblivion. You just got to give up, right? No deal. That's what he was saying before. Now, of course, everybody says, well, that's how he negotiates, right? He's got to say all this stuff. So again, if that's the case, you can't believe what he's saying. Maybe he has to lie in order to get what he wants, but why are we taking it seriously? If we know that that's his style.
When messaging flips overnight, the real signal isn't diplomacy, it's positioning. As Peter Schiff points out here, a complete reversal from no deal to productive talks exposes how narrative volatility is being used as a tool, not just communication. Markets don't have time to verify truth. They price the headline instantly, which creates opportunity for those ahead of it. This isn't a negotiation strategy alone. It's a mechanism that can move trillions in market cap within hours. Investors need to question whether price action reflects reality or reaction. Next, Peter Schiff discusses how these narrative shifts align with suspicious market timing.
So now this comes out and it's a huge reversal. Dow goes up like 1,000 points, 2,000 points. I mean, it gave back some of it, but it was a huge rally. Oil dropped like $10, right? Oil was way up. It went way down. Gold reversed, didn't really go positive, but gold was down like $250 before the post, and it recovered those losses. Silver, which was down like $4, went positive a couple of bucks. So everything reversed. And I have a hard time believing that somebody didn't know that post was coming and didn't make some bets, either in the S&P 500 futures or oil futures or currency futures. And in fact, now I'm hearing all these reports about mysterious large trades that were placed in the S&P in oil 5 minutes before that post. Very, very large wagers of a size that nobody would make just on a random hunch. And why would you even have that random hunch? Who the hell would know?
Markets don't usually move this precisely without someone seeing the script early. As Peter Schiff points out here, a 1,000 to 2,000 point Dow surge, $10 oil drop, and rapid reversals across gold and silver within minutes signal coordinated positioning, not a random reaction. Reports of large futures trades minutes before the announcement raise serious questions about information flow and fairness. This is where retail investors are structurally behind. Reacting after the move is already priced in. It's not just volatility, it's timing asymmetry. Next, Peter Schiff unravels whether these moves are coincidence or something far more deliberate.
The only way somebody would come in with that size at that particular time is if they knew exactly what was going to happen and they knew exactly the effect that it would have on the markets. Now, I don't know if the reason that post came out was so whoever had the inside information could make money, or maybe Trump was just looking at the bond market going yippee, the stock market tanking, oil surging, and he used Truth Social post knowing that post would lift the markets, that's the reason. Because so far the Iranians have denied that there's any talks or that they're making any progress. And again, I'm not going to necessarily believe what they say either, but I can't believe what anybody says. Anyway, buy some gold and silver before we rush up to new highs. before the markets realize that win or lose this war, gold's going higher. And the longer it continues, the more bullish it is, despite how the markets are trading. And these gold stocks, they are the best buys. They came down dramatically as a result of this. All of this is noise. None of this is going to matter to the massive profits these gold mining companies are going to be earning for years and years to come. Even though gold prices have come down, they're still $4,500 an ounce. Yes, silver's come down. It's $70. These are great prices. And these mining companies are going to make a fortune, and they're going to make even more money because the market is going to move to new highs. And I think before the end of the year. So this is just a very small bump in a long road. We've got a long way to go. And I think the destination, again, is going to make the bumpy ride worth it.
When trust in market signals breaks, investors are left navigating noise instead of clarity. As Peter Schiff points out here, if large positions are placed with precision before major announcements, it suggests markets are being influenced as much by excess as by analysis. That creates a dangerous environment where fundamentals take a backseat to timing advantages. Despite that, long-term trends still matter. Gold holding above 4,500 and silver near 70 shows underlying strength despite volatility. For investors, the real decision is whether to follow price swings or position for macro direction.